The whole point is simple: to read what raw price action alone can never show you. Let's begin. Here's the foundation. The price you see on your chart is what we call secondary information. All the real drivers of a market, the news, supply and demand, the big players' positioning, get compressed down into just two numbers: price and volume. That compression means a huge amount of information is lost. Order flow is the missing half. It's really just a detailed breakdown of volume, and it makes your price reading more transparent, more accurate, and more logical. But hold on to this mindset. Order flow is an ally, not a replacement. Price sits at the top of the hierarchy. Order flow contextualizes it. The edge comes from combining the two, never from choosing one over the other. Think of information in three tiers. Primary information is the real-world stuff that actually moves a market. For oil, that's OPEC decisions, geopolitics, reserves. This is the strongest edge there is, which is exactly why trading on insider information is a crime. Secondary information is price, volume, and therefore order flow. It's only a reflection of that real market, but it's the best most of us can access. Tertiary information is lagging indicators, things like moving average crossovers. They take information that's already incomplete and degrade it further. The takeaway: smart money works as close to primary information as possible. As a retail trader, you compete best by mastering the strongest form of secondary analysis: price action combined with order flow. This is the theory that ties everything together. A market is a continuous auction. Buyers want to buy low, sellers want to sell high, and where they meet is the point of equilibrium, also called fair value or acceptance. When buyers and sellers roughly agree on value, the market is balanced. That's a range. Volume is high, price spends a lot of time there, and it becomes an area of acceptance. When new information changes their perception, the market becomes imbalanced. That's a trend, the search for a new fair value, what we call price discovery. Volume is lower and price spends less time there because it's an area of rejection. And here's the rule that matters: price is attracted to areas of acceptance and repelled from areas of rejection. Now add one crucial layer. This balance and imbalance rhythm happens at every scale at the same time. Inside a big trend, you'll find small consolidations. Inside a big range, you'll find sharp little trends. Zoom into any of them, and they look just like the larger structure. That's what we mean when we say markets are fractal. They're self-similar. Patterns repeat inside themselves. Why does this matter to you? Because different crowds of traders are watching different time frames. Time frames coexist, interact, and intersect in the same arena. That's what creates the messy, chaotic look of price, but it's also where the opportunity lives. Your job is to spot the moments when those separate crowds of well-informed traders line up and act when they agree. Let's make liquidity intuitive. Liquidity is the ease with which a market can be traded without moving the price much. Picture a person trying to walk across a swimming pool. If the pool is full of deep water, they move slowly and with effort. That's high liquidity, like a consolidation. If the pool has only shallow water, they run right across. That's low liquidity, like a trend. The person is price. The depth of the water is market depth. So here's the insight most traders miss: a move that looks powerful doesn't necessarily have power behind it. Price can rip through a level simply because the water was shallow, low liquidity, not because there was real force. Consolidations act as support and resistance because the market remembers they were deep water. Trends don't hold because they were shallow. Now the nuts and bolts. There are really two families of orders. Market orders execute immediately at whatever price is trading right now. Pending orders wait at a different price, and they come in two types: limits and stops. A limit order gets you a better price. A buy limit sits below the current price because buyers want to buy low. A sell limit sits above because sellers want to sell high. A stop order gets you a worse price, and it's used for breakouts or exits. A buy stop sits above the current price, a sell stop sits below. One distinction that matters: limit orders are active. They sit visibly in the market. Stop orders are held by your broker and stay invisible until price reaches them. Simple way to remember it: market fills you now, limit fills you better, stop fills you worse. Every trade is a meeting of two kinds of players. Aggressive players use market orders. They initiate the price movement and they take liquidity. Think of them as the mover. Passive players use limit orders. They don't start moves, but they can slow one down or stop it, and they provide liquidity. Think of them as the wall, and here's the mechanical rule that underpins all of order flow. An aggressive order must always match a passive order. If you want to buy aggressively, there has to be a passive seller on the other side. Hold on to that. It's the reason the footprint columns work the way they do. The order book, also called the DOM, shows all the resting limit orders. Buy limits sit below current price on the bid side. Sell limits sit above on the ask side. The length of each bar is the market depth at that level. How many orders are stacked there? A deep level, with lots of orders, is hard for price to push through. A shallow level is easy, so as aggressive buyers eat through the sell limits above, price climbs one level at a time. Fast through shallow levels, slow through deep ones. That's the clean theory. But keep a note of caution, because this is a real-time tool showing intent. And intent, as we're about to see, can be faked. Here's the first big problem with reading real-time order flow. It can be manipulated, and this got far worse after high-frequency trading algorithms arrived around 2008. Spoofing is the first tactic. A player places a huge limit order to create the illusion of a wall, to lure the market toward it, with no intention of ever filling it. Then they cancel it just before price gets there. Pure deception. Iceberg orders are the second. Institutions place a large order, but only a small tip is visible in the book. As the tip fills, another hidden portion appears and so on. So a level that looks shallow might actually be hiding enormous size. The consequence, shallow levels might really be deep, and deep levels might really be shallow. Real-time intent can't be trusted. You're on the weaker side of the information game. The second problem is ambiguity. Most retail traders assume everyone is betting on direction. That's just not true. There are three kinds of participants. Speculators do trade direction, buy low, sell high. That's what people expect. Arbitrageurs trade a relationship between two markets. They might buy market A and sell market B at the same time. They don't care whether A goes up or down, only how it moves relative to B. Hedgers trade to offset real-world risk. For example, a bank running delta hedging. Direction is beside the point. They're managing volatility. So a buy order isn't always a bet that price will rise, and a sell isn't always a bet that it'll fall. That ambiguity muddies any attempt to read intent from raw buying and selling. The third problem is volume you simply can't see. A lot of trading happens over the counter, directly between big parties, and in dark pools, private venues where institutions hide large orders until after they've executed. Let me give you the scale, using 2023 numbers. Global GDP that year was roughly $105 trillion. The volume traded in the over-the-counter derivatives market alone was around $600 trillion, several times larger than the entire world economy. And most of it executes away from the public tape. There's a practical fix here. Focus on futures. Futures trade on centralized exchanges, so the order flow data is far more transparent than something decentralized like spot foreign exchange. So let's put the three problems together and make the key decision of this whole course. Real-time intent, the order book, the DOM, the tape, is compromised by spoofing, by ambiguous participants, and by hidden volume. Trying to trade off it as a retail trader is mostly a vain exercise. So we pivot. Instead of reading intent, we read historical activity, the footprint, the volume profile, and cumulative volume delta. These tools show what actually executed, not what someone wants you to think will execute. They let us measure levels of activity, and on futures that data is clean. That's the mental shift that makes everything else work. Stop reading intent and start reading activity. Here's our toolkit, and notice how they nest together. The footprint shows volume activity inside each individual candle, the bid, the ask, the imbalances, the delta. The volume profile shows volume at price across a whole series of candles. The value area, the point of control, the high and low volume nodes. And cumulative volume delta shows delta accumulating over time, which reveals exhaustion and absorption through divergence. All three descend from Peter Steidelmeyer's auction market theory. The whole spirit is the same. See what most of the market isn't seeing. Let's read a footprint. Each candle gets two columns. The bid column, on the left, shows selling aggression, aggressive sellers hitting passive buy limits. The ask column, on the right, shows buying aggression, aggressive buyers hitting passive sell limits. This trips people up, so hold on to that rule from earlier. An aggressive order always matches a passive one. That's why bid means selling and ask means buying here. The darkest cell is the high volume node, the price level with the most activity inside that candle, a spot price often reacts to. The thin bars flagged on the side mark imbalances, and the difference between total ask volume and total bid volume gives you the delta for that candle. Here's a detail that's easy to get wrong. You do not compare the bid and ask horizontally on the same row. You compare them diagonally. Why? Because when buyers attack, they hit the sell limits one level above. When sellers attack, they hit the buy limits one level below. So the meaningful comparison is a diagonal one. The standard threshold is 300%. When one side has at least 3 times the volume of the diagonal level next to it, that's an imbalance. In the example, the ask shows 24,000 against 6,900 on the bid diagonally below it. 24,000 divided by 6,900 is 3.46 times. Well over 3 times. So that's an ask imbalance. When several stack up in a row, you've got stacked imbalances, which are stronger still. Now we read what those imbalances mean using where the candle closes. There are 2 core signals. Initiation is continuation. When price closes above imbalances in the ask, that's buying initiation. Real buying with directional intent that drove price through. Close below imbalances in the bid, and that's selling initiation. Absorption is a reversal signal. When price closes below an ask imbalance, meaning all that buying aggression failed to move price up, the buyers are being absorbed by hidden sellers. And when price closes above a bid imbalance, the sellers are being absorbed by buyers. Put them in sequence and you get a reversal. Absorption of one side, then initiation in the other direction. That's a powerful high-conviction turn. Delta is the difference between ask volume and bid volume in a candle. Normally, a bullish candle has positive delta and a bearish candle has negative delta. When that breaks, you've got a delta divergence, and it's a sign of absorption. A bullish candle with negative delta means sellers were being absorbed. All that selling pressure still couldn't stop price closing higher. A bearish candle with positive delta means buyers were being absorbed. But here's the honest caveat. Delta only tells you the net aggression. It doesn't tell you where in the candle that aggression happened. So delta on its own is ambiguous. Always read it together with the imbalances and the candle's shape, because the imbalances tell you the location, and location is what gives delta its meaning. Now stack delta over time, and you get cumulative volume delta, CVD. Its real power is divergence, and there are 4 signals to know. First, price makes a higher high, but CVD makes a lower high. That's buying exhaustion, and price may reverse down. Second, price makes a lower high, but CVD makes a higher high. That's buying absorption, also pointing down. Third, price makes a lower low, but CVD makes a higher low. Selling exhaustion, pointing up. Fourth, price makes a higher low, but CVD makes a lower low. Selling absorption, also pointing up. The logic is exactly like divergence on an oscillator, except instead of momentum, you're comparing price against volume. And because markets are fractal, you'll sometimes find one of these divergences nested inside another, an even sharper signal. Onto the volume profile. It's a horizontal histogram showing how much volume traded at each price level across a stretch of candles. The value area is the range holding 70% of the traded volume, your zone of fair value, and it acts as a magnet for price. That 70% isn't arbitrary. It comes from the statistical rule that about 68% of data falls within one standard deviation of the mean, rounded up. Inside the value area, the single price level with the most volume is the point of control, the fairest value of all. A practical tip: the default 70% setting is often too wide. Drop it to 40% when you want a tighter, more tradable zone. The point of control doesn't move, only the edges pull in. 2 more features of the profile. A high volume node is a price level with lots of volume, an area of acceptance and fair value. It attracts price like a magnet. A low volume node or a flat low-volume area is rejection, low liquidity, and it repels price, sometimes violently. Watch especially for flat, low-volume areas hiding inside a single wide-range candle. Those are liquidity voids, spots where price accelerated away hard because there was nothing there to slow it down. When price returns to one of those voids later, it often gets pushed away again because the market remembers. And these precise areas simply cannot be seen with candlesticks alone. You need the profile or the footprint to find them. Here's a subtle read at market extremes. A price extreme is, by definition, an area of great rejection. So volume should thin out as you reach the very tip of the turn. When it does, when volume tapers to almost nothing at the extreme, that's a finished auction. The high or low was formed properly, and it's likely to hold. When volume stays high, right at the extreme, that's an unfinished auction. There's unfinished business up there, and the market may well come back to revisit that level and complete it. This is genuinely useful for judging whether a trend has actually ended, for setting targets, and for anticipating bull and bear traps. Now let's look at how the value areas of neighboring candles relate. This is relative footprint analysis. Two things can happen. When two adjacent value areas overlap, price has found a shared area of fair value. That overlap acts as a magnet. A zone price is drawn back to, good support or resistance. When two adjacent value areas gap apart, you've got an imbalance between the candles. That gap becomes a rejection zone, a place price gets repelled from if it returns. The benefit, once again, is that you're seeing attractors and repellers that are completely invisible on the raw price chart. And these tend to be most telling, right around significant reversals. Let's talk about the volume-weighted average price, VWAP. It's the average price weighted by volume from a chosen starting point, and institutions live by it because it's their benchmark for whether a trade was executed well. The VWAP line itself acts as support and resistance. Around it sit the sigma bands, standard deviation bands, just like Bollinger Bands. The inner pair is 2 sigma away, the outer pair is 3 sigma away. A few practical reads. A steeper VWAP angle gives stronger support and resistance. The space between the 2 sigma and 3 sigma lines works as overbought and oversold zones, especially when VWAP is flat. And when price pokes past the 3 sigma line, it often snaps back sharply. A great spot to take profit at an extreme. The anchored VWAP lets you choose the starting point yourself, and this is where it becomes a true fractal tool, a geometric anchor point feeding a numerical calculation. There are 6 anchor points worth knowing. 1. The session start, which day traders love. 2. Prominent highs and lows. 3. Major news. The non-farm payroll report is the most violent one. 4. Stock-specific events, earnings, dividends, and splits. 5. The location of a false breakout. And 6. Opposing extremes, where you anchor one VWAP on a high and another on a low to form a band. One warning to internalize, the false breakout. Price will often deceptively poke just past the VWAP and then come back to respect it, because getting long just below it or short just above it is advantageous for institutions. When price breaks it and comes right back, that's frequently a good trade. Here's a technique that uses pure price action, based on everything we've learned about fair value. You can define a consolidation, an area of fair value, by finding where candle ranges overlap. Take 2 adjacent candles and mark the range they share. Now add a third, and the shared zone narrows. Add more overlapping candles, and it narrows further into a tight, high-conviction band. That common path across the candles is a fair value zone that price will often respect as support or resistance later. This works because order flow and candle geometry are correlated most of the time. Not always, but enough that this is a fast, clean way to spot a fair value zone without any indicator at all. Market structure gives us the context to know which levels matter, and it comes down to 4 core reversal patterns: the failure swing, the non-failure swing, the double pattern, and the V pattern. These come straight from the work of Charles Dow and Richard Wyckoff more than 100 years ago, and they endure because they're driven by human nature, which doesn't change. They're simple, but because markets are fractal, they intertwine across scales to produce every complex reversal you'll ever see. One more concept to layer on. Stable versus unstable structure. Structure is stable when a player stands their ground and closes beyond the last extreme. Buyers closing above the prior high, sellers below the prior low. It's unstable when a player gets absorbed or manipulated, or fails to break the last extreme. Pay attention to stable structure, though watch out, because minor stable structure often turns out to be decisive. If you take one principle from this entire course, make it this one. Integration. It's the father of all technical analysis principles. No single technique is strong enough to trade on its own. Not the VWAP, not the profile, not one imbalance. The quality of a trade comes from how many independent tools point to the same place at the same time. Support and resistance, a supply or demand zone, a footprint imbalance, a CVD divergence, a VWAP sigma line, a reversal pattern. When several of those intersect at one price, you have something real. Remember the fractal picture. Many crowds of well-informed traders watching different tools on different time frames. Your job is to act precisely where they intersect in time and price. That intersection is the edge. Let's walk one example, the way you'd actually read it. Price is selling off and approaches a level. You plot a volume profile on the down move, and the point of control lines up right where price is arriving, a fair value support line. At the same time, your CVD is making lower lows. Sellers pushing hard, but price refuses to break down. That's selling absorption. The sellers are being eaten by buyers. So you zoom into the footprint on the candles touching that support. You see a high volume node below the close, buying initiation as price closes above, ask imbalances, and the candle closing back inside the value area. Stack it all up. Point of control support, selling absorption on the CVD, buying initiation on the footprint, and you get a violent reversal to the upside. That's integration in action. Here's how to run all of this in order so you don't drown. 1. Start with basic market structure. Count the highs and lows in the major and minor scales. 2. Scan for the 4 reversal patterns. In both scales, never ignore the minor flow. 3. Find the support, resistance, supply, and demand levels intersecting those patterns. 4. Assess CVD divergence in the major and minor flows. 5. Highlight your key areas and watch how price reacts if it gets there. 6. Avoid analysis paralysis. Get a tool's perspective, then erase it. The context lives in your mind, not on the chart. 7. Refresh the charts with a clean look. 8. Watch chart region bias. Keep price in the middle so you're not fooled. 9. Not too close, not too far. 10. Imagine the possible scenarios ahead. 11. Watch both sides, but honor the overall trend. 12. Zoom into the detail only when price reaches a level that matters. 13. Accept that risk is an emotional choice. Reason and emotion can't be fully separated, so no amount of analysis removes the leap. 14. Define your stop, target, and entry, aiming for a reward to risk around 3. 15. Accept losses as inherent to the game. And 16. Discipline. Follow the rules you set before the trade, take the stop when it hits, and let winners run. Let's be honest about both sides. The advantage is, order flow combines volume with price into a genuinely reliable framework. It reveals what price alone can't. It puts an X-ray on reversals. It lets you test the real reliability of your support and resistance. And it shows you levels you'd never see otherwise. The disadvantage is just as real. It's overwhelming to learn at first. The problems of ambiguity, manipulation, and hidden volume never fully disappear. You manage them, you don't eliminate them. The tools confuse you without proper perspective. The contextual reading takes real screen time to develop. And it's hardest exactly where speed matters most. On the low time frames. Go in clear-eyed. This is a powerful edge, not a magic wand. So here's where we land. Read activity, not intent. The real-time book is noise you can't trust. The historical footprint of what actually executed is signal you can. Integrate your price action with your order flow. Act only where multiple crowds of well-informed traders intersect in time and price. And then manage your risk with discipline, because you're analyzing secondary information. The veil of uncertainty never fully lifts, and it isn't supposed to. Master the tools, respect the ambiguity, and trade the intersections. That's order flow. Good luck out there.